The stock market's been on a wild ride since November of 2023. Are we going to maintain it in 2024? Stay tuned. Welcome back to Financial Wellness Planning. My name is Derek Coffey. I'm the founder of FWP. And one of the things that we're going to go over periodically is what the stock market's doing. Regardless of any of the information that I give you, the only thing that the majority of people are going to actually care about is what's going on in the stock market. So periodically, I'm going to put out videos where we're going to review what the stock market's doing and the reasons why the stock market's reacting the way that it is. When I talk about the stock market, I'm talking about the stock market in general. I'm not going to focus on specific stocks unless there is one that is changing the market one way or the other. But in general, what we want to discuss is what the broad-based market is doing. The easiest way to explain to you what the market is doing is to look at the broad-based indices that you see in the news every single day. The first index that you're probably most familiar with is the Dow Jones. And the reason this is any headline typically includes what the Dow Jones is doing because the movements are much greater in terms of points. One day, the Dow Jones may be up 500 points. The next day, it might be down 400 points. But the Dow Jones is what creates that attention-grabbing headline. To understand what the Dow Jones is, I'm going to break it down for you. The Dow Jones is made up of 30 blue chip stocks, and these stocks are meant to be an indication of what the overall U.S. economy is doing. Typically, if the Dow Jones is going up, the U.S. economy is very healthy. If the Dow Jones is going down, there's probably something to worry about. But the purpose of the Dow Jones is to give us a pulse on what the U.S. economy is like. On the screen, you can see how the Dow Jones is broken down by sector. What you'll notice is that financials actually leads the way. Technology is number 2, and this is going to be different from the other 2 indexes we're going to go over. Since its inception, the Dow Jones has an annual rate of return of 8.89%. It's very good, maybe not as good as the S&P 500 or the Nasdaq, but it is still very good. And the reason that the Dow Jones typically lags the other indices is because they're not as heavily weighted into technology. The second index that you're going to see a lot about is the Nasdaq Composite. And what the Nasdaq is it's a collection of the 2,500 stocks that are listed on the Nasdaq exchange. The difference between the stocks that you're going to see on the Nasdaq versus the Dow Jones and the S&P 500 is there is a mixture of U.S. and international companies. The weightings of the stocks that are within the Nasdaq are much different than that of the Dow Jones. The Nasdaq has a 59.81% weighting towards technology. This is 3 times the amount that you're going to see in the Dow Jones. With the Dow Jones, financials is what led the way on where the stocks that make up the Dow Jones comes from. With the Nasdaq, financials make up 3.5%. So there's a very big difference between the Nasdaq and the Dow Jones. And you're also going to see that in the average rate of return that the Nasdaq has had since its inception. Since its inception, the Nasdaq has returned 13.65%. The reason that the Nasdaq has returned so much more than the Dow Jones is mostly related to the weighting of technology. The final index that we're going to go over is the S&P 500. And this is the index that I'm going to refer to going forward when I discuss the markets and what they're doing. The S&P 500 is made up of the 500 largest U.S. companies, and these companies are updated every quarter. Since its inception, the average rate of return for the S&P 500 is 10.22%. You'll notice that the weightings of the S&P 500 differs from the Dow Jones and the Nasdaq. Like the Nasdaq, the S&P is still most heavily weighted towards technology stocks, and in this case, around 30%. But second are those financials. The Dow Jones, where the financials was number 1 and then technology was number 2, it's flip-flopped for the S&P 500. But the S&P 500, I feel, is the most applicable to keeping track of what the total stock market is doing. As opposed to 2,500 stocks with U.S. and international exposures or just 30 blue chip stocks, the S&P 500 is actually going to give us exposure to the 500 companies that are the engine of our economy. And there are some people that are going to say, hey, well, what about those international stocks? And I'm not going to focus on international stocks as much. The reason this is one, because the US typically leads the world economy. Whatever the US does, typically the rest of the world follows. But also, as of 2024, over 40% of the revenue that the S&P 500 companies receive comes from outside of the US. So to me, the S&P 500 gives you some exposure to what's going on in the international community. And sure, there are other indexes that you could follow, like the Russell 2000. But to me, the success of investing comes from simplicity. Using the S&P 500 is simple. I don't believe in stock picking. Yes, you can hit a home run. You may have purchased Bitcoin when it was at the bottom, but consistently picking the winners is almost impossible to do. For the everyday investor, it is impossible to do because before you can place a trade, there's a computer that's already placed 100 more before you could hit submit. Now understand, I'm not pitching how you should invest your money. The whole purpose of these videos is what's going on in the market and how it may be affecting the money that you have invested. So don't take any of this as investment advice. Find a licensed professional that can give you that advice and actually help you with your investments. But use these videos as an information tool. That way you can see what's going on and then work with that advisor to make informed decisions. So what's going on with the market in 2024? The first quarter of 2024 was just an extension of the last quarter of 2023. Overall, the S&P 500 was up over 10.5% for the first 3 months of 2024. On your screen, I've also put in here 3 other asset allocation types. Portfolio 1 is a 50-50 stocks to bonds. Portfolio 2 is a 60-40, and Portfolio 3 is a 70-30. The reason that I put these in here is because if you are retired or you're getting close to retirement, your investment should be dialing back their risk. You shouldn't be 100% in stocks. So with that being the case, I think it's important to model for you what other asset allocations may look like. Through March 31st of this year, a 50-50 portfolio has returned 4.68%. A 60-40 has returned 5.75%. A 70-30 portfolio has returned 6.82%. And then again, the S&P 500 is up 10.5%. Now that was through March 31st. The first week of April became a headache. There was a lot of data that came out the first week of April that has really spooked the stock market. This spooking is all because of interest rates. The run-up from November of 2023 through March of 2024 was all due to the prospect of the Federal Reserve cutting interest rates. As we've gone over previously, the S&P 500 is tilted 30% to technology stocks. The reason interest rates mean so much to technology stocks is because those stocks are valued based on their future earnings. The calculation of those future earnings are directly impacted by where interest rates are. If interest rates are lower, then the value of those future earnings is higher, and vice versa. So with the prospect of the Federal Reserve cutting interest rates 3 times in 2024, the value of tech stocks went up. This led the S&P 500 to be up over 10.5%. Because of jobs data, inflation data, and all of the other economic metrics that are coming out, there's been a worry that the Fed may not cut rates as many times as we anticipated. Because of this, that first week of April, we saw all 3 of those portfolios as well as the S&P 500 lose almost 1% of their gains for the year. Now, in those portfolios, I mentioned bonds. Bonds operate the exact same way when it comes to interest rates. The value of a bond is based on the income that you're going to receive. In most cases, the income you're going to receive is in the future. If interest rates are low, the value of that future income is higher. If interest rates are higher, the value of that interest income is lower. For the exact same reasons as the devaluation of tech stocks because interest rates may remain higher, bond prices are also down because interest rates may remain higher. If you're invested in a stock and bond portfolio, if interest rates go up, then there's a high probability that you're seeing downward pressure on your account balances. You have to be patient with this because we don't know what's going to happen. So my hope is with this base understanding of what interest rates are doing to your investment accounts is that you will remain patient. 2024 is going to be a weird year. We don't know what the Fed's going to do with interest rates. We also don't know what the outcome of the November election is going to look like. The stock market's going to take us on a wild ride. It could be up, it could be down, it could be flat. We don't know. We have to remain patient and let it play out. Again, I don't have a set timetable on how often I'm going to comment on the market. I would assume it's going to be quarterly, but I haven't made that decision yet. But in the meantime, if there is anything major that causes the market to go one way or the other, I will do a video about it. I want to thank you for tuning in. If this video or any of the other videos that I've put out are bringing you value, then hit that subscribe button. It's only going to help me get this information in front of more people. Feel free to like the video, comment on the video whether you agree with me or you don't, and then share it to someone if you think it's going to provide value to them too. But thank you again for tuning in. I'll talk to you soon.